One tax surprise that catches a lot of investors off guard is something called phantom gains. This usually happens when you own a mutual fund inside a non-retirement account, like an individual TOD account, a joint account, or maybe even sometimes a trust account. Here's the simple explanation. When you buy a mutual fund, you are buying into a pool of investments that may already own stocks with large built-in gains. So even if you personally just bought into the mutual fund, the fund itself may have owned certain stocks for many, many years. Let's use Apple as an example. Imagine you buy into a mutual fund in 2026. You just became an investor in that fund, but that mutual fund may have purchased Apple stock many, many years earlier at a much lower price. Now, let's say that in 2026, the mutual fund manager decides to sell some of that Apple stock. The reason for the sale could be a variety of reasons. Perhaps there's a lot of mutual fund investors that want their money back, so they have to sell out of positions to raise cash to give to those investors. Or maybe they feel Apple stock has had its run and we want out. Regardless, at the end of the day, they decide to sell that Apple stock. Now, if Apple had a big gain inside the fund, that gain may get passed through to you as a capital gains distribution. And here's the frustrating part. You could owe taxes on that gain even though you did not personally own that fund during the years when Apple had its big run up. You may have only owned the fund for a few months. You may not have sold anything yourself. Your account value may not even feel like it went up. It could be also down. But because that mutual fund sold appreciated positions internally, you can still receive a tax bill. That's why people call it a phantom gain. It feels like you're being taxed on a gain you did not really experience directly. Now, to be clear, the gain is real inside the fund, but from your personal perspective, it can feel like a surprise because you did not choose to sell Apple, and you may not have benefited from all of that growth that happened before you bought into that fund. This is one of the big tax issues with mutual funds in taxable accounts. You do not fully control when the fund buys and sells. That fund manager is the one making those decisions. And if that fund distributes capital gains, you may owe taxes whether you wanted that income or not. You have no control. That is very different from owning individual stocks or certain more tax-efficient strategies where you have more control over when the gains are actually realized, aka when you get that 1099 at the end of the year. For retirees and investors with non-retirement money, this matters because capital gain distributions can affect more than just your tax bill. They could potentially impact your taxable income, your Medicare premiums through IRMA, the taxation of Social Security, and your overall retirement income plan. So the main takeaway is this. Before holding mutual funds in a taxable account, make sure you understand that you may receive capital gain distributions even if you do not sell anything yourself. In retirement planning, we don't just care about what you earn, we care about what you keep after taxes. And avoiding surprise taxable income is a big part of building a more tax-efficient retirement income plan. If you own mutual funds out in a non-retirement account, we would encourage you to reach out to us in our team, and we can show you exactly how to eliminate phantom gains in your account. We'll see you in the next one.